Hello and welcome to the Kingsview Investment Management Q2 Portfolio Review and Investment Outlook. My name is Scott Martin, Chief Investment Officer at Kingsview Investment Management. I'm joined today by some familiar faces, Paul Nolte, Senior Vice President and Portfolio Manager at Kingsview Investment Management, and Buck Dormeyer, Chief Technical Analyst and Portfolio Manager with us at Kingsview Investment Management. Thank you both for joining us. It's funny to be in such tight quarters here, but I understand you guys are virus-free, so we'll just keep the distance as is for now and hope you at home are doing okay and staying safe also. One thing that seems like has become, I guess, a little bit more safe, gentlemen, in the last, say, few weeks and months has been the stock market. Both actually, not just the stock market, but maybe the bond market as well and some alternatives. Paul, if you could lead us off here and just talk a little bit about some of that movement that we've seen in all asset classes over the last several weeks and months as we bounced out of that difficult, say, quarter end that we had in quarter one, and then also how we kind of looking at things going forward, please.
Yeah, it's interesting because the markets bottomed out at the end of March. The economy hadn't quite bottomed yet, and we're now starting to see a rebound in a lot of the economic data. And it's been supportive of the higher stock market. Now, mind you, the market took off when the Fed came in and began to provide a lot of liquidity and funding. And that's what investors wanted to hear because it's a replay of 2008 and 2009. So what we were waiting for is the economic data to rebound. And as bad as the numbers were in the first quarter, the numbers were fabulous in the second quarter as we came back. So we're talking about all the different letters of the alphabet that the rebound is looking like. It could be a V, it could be a W, a lazy W, a swoosh was the early one. We're now talking more about maybe a square root. So as the economy's opened up, we're noticing now that we're starting to see a pickup in the virus, things may start to slow down a little bit, or at least the fear of that. And the market's not yet reflecting that. I think the markets are looking for some bottoming process in earnings, which we're just starting now, and we will see better earnings going forward, figuring that this is probably the worst part of the year and the worst quarter that we're going to experience. We should be improving from here. So the market should continue to improve as earnings improve.
Yeah, and it feels like some of that elation is bound to wear off. I mean, things felt so bad at the end of Q1. I mean, it was darkest certainly before dawn. And then things got decently better, and better so much more in the asset class prices than anything than the actual data, to your point. But some of that elation, again, to use that word, seems like it's due to wear off a bit for that next point, which takes me to you, Buck Dormeyer, our Chief Technical Analyst, because that's one thing, too, that you were pointing out a lot towards, I believe, the end of the first quarter and early second quarter. Talk to us about some of the technical movements that's been going on, say, in some of the big asset classes out there with respect to the charts, please.
Yeah, so to go back to that, at the end of that first quarter, we had that, at the very end, we had that capitulation signal on the VPCI V bottom. And that's been the capitulation sign that has driven this market higher. Follow that up with some of the internals that we look at. The early first quarter, we saw the new highs, new lows starting to improve. But most importantly, we had our two big indicators, capital weighted volume and the advanced decline line, both break their trend. And when that happened, we started to see the market really start to gain some significant momentum. But you said sectors, Scott, and what we're seeing now when we look at like data like the new highs and the new lows, that has just recently broken trend, but the number of stocks trading above trend has still not broken out of its trend line resistance. So what does that tell us? That tells us that we're in more of a fragmented market. These e-commerce stocks, these biotech stocks, these healthcare stocks have been doing really well. But much of the rest of the market is improved, but is not made the strides that these other sectors have.
Yeah, that's a great point. I mean, it's been one of those, I guess to say a stock picker's market or like a stock pick market in the sense of like there's been like 10 of them, and then everybody else, to your point, in the S&P 5. And I think to dovetail on Buff's point, Paul, you look at this a lot as part of the investment committee when we meet every couple of weeks and talk about things going on in the asset class world, certainly things going on in price movements, yield curve, etc. Talk to us a little bit about that breakdown between, say, growth and value, small and mid cap versus large and so forth, and how that chasm has continued to kind of exist at times.
One of the things that we've noticed in past end of bull markets, beginning of bear, and beginning of new bull markets is you see a shift in leadership. We saw it in 2000 going from tech to pretty much everything else. And then in 2008, 2009, away from financials and now back into technology. So technology has led the market the last 10 years, and part of the reason why the S&P has been the dominant asset class. We think we're going to see another change, but right now where the valuations have gotten very expensive, especially on the technology side. The comparisons have been drawn to 1999 valuations with some companies selling at 30, 40 times revenue numbers, similar to what we saw in 99. So we would expect to see that shift back to other asset classes, value. We would see small cap, maybe even international, with a little bit weaker dollar. So again, we're not there yet. We're still in that momentum phase. And as Alan Greenspan pointed out in 1996, 1997, 2 years before the market peaked, that we had irrational exuberance. We could be in that same situation where we're looking exuberantly today, but 2 to 3 years from now, kind of look back and go, geez, why didn't I sell then?
Yeah, good call. I think the Greenspan comment was, December of 96. And then we rallied really hard after that, especially 98, 99. So especially interesting there with respect to perspective. So perspective is everything, I think, going forward, Buff, especially when it comes to certainly fundamentals and valuation, as Paul talked about. But let's talk about some perspective on the charts, please. What are some things maybe in the charts we need to look forward to or look forward in with respect to how these charts might behave going forward that we should watch out for? Maybe is it a test of the 200-day moving averages in some cases? RSI, things in the charts that you're looking at going forward that show that this indeed is something that needs to be supported from a rally standpoint.
So the big thing, Scott, in the market right now is that we're still green light on our indicators. So as we look at like capital volume flows, they're still positive, and so that means that there's money coming in. The advanced decline line, which tells us there's plenty of liquidity in the marketplace. So all these are very positive signs to have a lot of confidence that we can continue the trend. And the other thing that you can look at, the other big catalyst that we've been talking about, is what the Fed's been doing. So the Fed has injected almost $3 trillion since the market bottom. And so what are they doing? They're buying, they're buying investors' bonds. And so the first question, where does that money come from? Okay. Mm-hmm. And then two is, once they buy a bond, that investor, what's he going to do with the money? And if you look at the alternatives, what are they going to do with this $3 trillion that's injected? You look at cash, it's not paying anything. You look at bonds, the interest rates are incredibly low. You look at spreads, they're back to normal despite the risk in the economy. And so you look at the dividend yields of stocks. So we're seeing, the earnings yields of stocks. And so we're seeing that money still flowing in to stocks at this point in time. And until the Fed takes the foot off the gas, we should continue to see the market trend higher, and we can view that via the advanced decline line and capital weighted volume flows.
Yeah, that's one thing that I think is attributable to some of your really empirical work, is that volume analysis, because to me, I agree with you with all the money flow that's out there. I mean, it's amazing what you can do these days when you can just add a zero to a balance sheet somewhere in like a computer system or in the monetary system. I mean, why stop? And that's what we're kind of seeing. I mean, with certainly the Treasury and the Fed, and I believe too, Paul, to your points earlier, going forward, we can expect some fundamental weakness, but maybe the weaker of that weakness might be gone. You know what I'm saying? So with respect to how things open again, to seeing how some of these job numbers come back, potentially even GDP numbers, which could bounce back at least in this Q3, because we're taping this in mid-July now, things might be on the mend, at least from the standpoint of where they were poorly so just a few months ago, gentlemen. So thank you both very much for joining us today. Very good insights, Paul and Buff. And thank you for joining us today as well. If you have any questions or comments about what you heard today, please reach out to your dedicated financial advisor at Kingsview Wealth Management, or you can reach us directly at the following email, investments@kingsview.com. Thank you.